Hey everyone and welcome. Today we're going to break down the world of investing. I know. It can seem super complicated, but honestly, it's one of the most powerful skills you can learn to build some real long-term wealth. So let's just dive right in.
So I want to kick things off by asking you something. Just think for a second about the money you have saved up, the cash that's just sitting in your bank account. Sure, you might see a tiny bit of interest pop up now and then, but is it actually growing? Is its real value going up?
Because here's the thing. Whether you realize it or not, there is a quiet, invisible force working against your savings every single day. It's like a thief that doesn't kick down your door, but it is constantly stealing the future value of your hard-earned money.
And that silent thief, well, it has a name: inflation. And this is the #1 reason why just saving money in a bank account isn't going to be enough to secure your financial future.
So what is it really? To put it simply, inflation just means that over time, your money buys you less stuff, right? The prices of pretty much everything, food, gas, you name it, they tend to go up. So that 100 rupees you have in your pocket today, it's just not going to stretch as far a year from now.
And check this out. This is where it gets kind of crazy. Look at how dramatic this is over the long run. If we just assume a pretty standard inflation rate of 7% a year, in 30 years, your 100 rupees today would have the same buying power as just 11 rupees. That's a nearly 90% drop in its value.
Let's make this super real. Back in 1990, a liter of petrol was less than 10 rupees. Today, that same liter is over 94. See? That's the power of inflation right there. It's not some abstract theory. It's something you feel every single time you go to fill up your tank.
Okay, so if inflation is the big bad thief, what's the solution? How do we actually fight back? Well, we need an engine. A wealth creation engine that doesn't just protect our money, but actually makes it grow faster than inflation can eat it away.
And this brings us to a really important idea: the real return. It's actually a super simple formula. You take your investment return and you subtract the rate of inflation. If that number is positive, congratulations, your wealth is actually growing. Anything else, and you're just running in place. Or worse, you're falling behind.
Now, when we talk about investments that can really beat inflation, we're usually talking about equities, which is just a fancy word for stocks. And I get it. Looking at the stock market's performance year to year, it can be pretty scary. The numbers swing like crazy, up 81% one year, down 38% another. It definitely looks like a wild roller coaster.
But, and this is a huge but, here's the secret. The whole picture changes when you just zoom out. If you invested in the Sensex for just 1 year, yeah, you'd have made money most of the time. Not bad. But look what happens when you stay invested for 15 years. The probability of making a profit becomes 100%. Time is the magic ingredient that smooths out all those scary bumps.
And this chart really drives that point home. Between 1980 and 2024, equities gave an average return of almost 16% a year. Compare that to a bank FD at just under 8%, which is barely keeping its head above water against inflation. The takeaway here is crystal clear. Historically, equities have been the most powerful engine for creating real, inflation-beating wealth.
Okay, so we know we need to get in on that equity action. But how does a normal person like you or me do that without becoming a full-time stock market guru? You need the right vehicle. And for most of us, that perfect vehicle is a mutual fund. Just think of it like a basket that holds a bunch of different stocks, and it's all managed by a team of pros. This solves two massive problems. First, you don't have to spend all your time trying to pick winning companies. The experts do it for you. And second, your money is automatically spread out, which is way less risky than betting everything on just 1 or 2 stocks. They're easy to get into, you can start small, and you can get your money out when you need to.
So now that we have our vehicle, our mutual fund, let's talk about the power tools you can use to really drive it effectively and, get the most out of your wealth creation journey.
The first and maybe the most important tool is compounding. I mean, Einstein supposedly called it the 8th wonder of the world, and for good reason. It's that magic that happens when your investment returns start making their own returns. It's like a snowball rolling downhill. It starts small, but it just gets bigger and bigger, faster and faster over time.
To really get how powerful this is, check out this analogy. Imagine you take 1 step on day 1. On day 2, you take 2 steps. Day 3, 4 steps. You just double it every day. How long do you think it would take to walk to the moon? The answer is absolutely staggering. Just 31 days. That's not a typo. That is the unbelievable, explosive power of compounding.
And this is how that plays out in the real world. A systematic investment plan, or an SIP, is just where you invest a small, fixed amount on a regular basis.
Look at this. If you invested just 1000 rupees a month for 20 years, you would have put in a total of 2.4 lakh. But thanks to the power of compounding, that money could grow to nearly 12 lakh rupees.
The next power tool is simply discipline. So many people think they can outsmart the market. Sell right before a crash, buy right at the bottom. But this chart shows you why that is a terrible, terrible idea. If you just stayed invested from 1990 to 2024, you'd have earned over 14% a year. But if you missed just the 10 best days in that whole time, your return plummets to 11%. The key isn't timing the market, it's time in the market.
And that brings us to our final and maybe the most critical point of this whole thing. We've seen the power of compounding and we've seen the power of time. So what is the actual real-world cost of just waiting, of putting this off?
Let's look at the story of two investors, Mr. A and Mr. B. Mr. A starts investing 9,000 rupees a month when he's 35. Mr. B waits 10 years and starts investing 15,000 a month at 45. Now, get this. By the time they're both 60, they've invested the exact same amount of money, 27 lakh rupees. But look at the results. Mr. A ends up with 2.6 crore. Mr. B, only 89.6 lakhs.
That single decade of waiting cost Mr. B over 1.5 crore. Let me put that another way. For Mr. B to have ended up with the same amount of money as Mr. A, he would have needed to invest over 43,000 rupees every single month. That is the staggering price of delay, and it perfectly shows why starting early is everything.
So, if there's one thing you take away from all this, it's this. Your most powerful asset as an investor isn't some hot stock tip or a giant pile of cash. It's time. And every single day you wait, that asset becomes a little less powerful. They say the best time to start investing was yesterday. Well, the second best time is right now. So the only question left is, are you going to use it?